Welcome, everybody. I am Wendy Saunders, partner and co-head of financial services at Lewis Silkin. And today we're here to talk about central bank digital currencies, the legal architecture, risks and opportunities for the UK market. So let's start off with the policy debate. Central bank digital currency versus new forms of private money. The debate about whether we should have a central bank digital currency, or CBDC, what it would look like, and what it would solve for, is generally considered in tandem with developments in the private sector and new forms of private money issuance. It is necessary for the payment system as a whole to have the right balance of central bank control, monetary sovereignty, and financial stability, whilst facilitating innovation, flexibility, and functionality for users. Consideration of these issues goes back further than you might think. Back in 2014, the Bank of England observed that it is very unlikely that a digital currency, as currently designed, would be used as the predominant form of money in any economy. It observed that the key innovation was not the cryptocurrency or the digital currency itself, but rather the introduction of a distributed ledger, which allows a digital currency to be used in a decentralized payment system, and concluded by saying that both digital currency status as money and the distributed ledger technology used by them have potential to develop over time, and that a variety of potential risks to financial stability could emerge if a digital currency attained systemic status as a payment system, most of which could be addressed through regulatory supervision of relevant parties. Early observations on the central bank digital currency were set out in a speech by the Bank of England in 2016, noting that it was an active area of interest and research, and it produced a paper looking at the macroeconomics of CBDCs. However, fast forward to 2019, and it was a prospect of a stablecoin, being a digital currency backed by assets, thereby aiming to maintain a stable value, achieving, in a very short timescale, widespread adoption for transactions currently processed by retail and wholesale payment systems, particularly if integrated into existing online platforms or social media, that brought stablecoins into the sharp focus of national and international regulatory bodies. That stablecoin was Facebook-backed Libra. Key conditions that facilitated this proposition included lack of universal access to financial services for a large share of the world's population and inefficient cross-border retail payments. That led to an urgent review of the potential impact of stablecoins and was a catalyst for accelerating work on CBDCs, potentially as a counter to the risks of a globally systemic stablecoin. In October 2019, a G7 working group on stablecoins highlighted key concerns in relation to global stablecoins. Firstly, competition. Global stablecoin arrangements could achieve market dominance due to their strong existing networks and the large fixed costs that a potential competitor would need to implement large-scale operations and the exponential benefit of access to data.